You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the Deep Dive. We've got quite a stack of briefings today, haven't we? Everything from tiny ticks in FX markets to, well, major geopolitical flare-ups.
Yeah, it's a lot coming in.
So our mission, as always, is to synthesize this, cut through the noise for you, and pull out the key insights on how these things, FX, commodities, trade tensions, even conflict, they seem separate, but are they really? We think they're moving in lockstep.
Exactly. We're not just reading headlines here. We need to get to the so what, because you've got monetary policy flashing signals about easing, maybe the big shift there.
Right.
But at the same time, security risks are just spiking. That creates this fundamental conflict, you know? And we want to focus on where that conflict shows up in market prices and policy decisions, basically give you the high-impact knowledge you need.
Okay, good plan. Let's start with that monetary pulse then, section 1, FX first. It's been remarkably quiet, hasn't it? The dollar index basically stuck in this super tight range, like 97.70 to 97.825.
Yeah, it is almost paradoxically stable.
Right. Because the signals from central banks have been anything but quiet this week. So why is the dollar sort of trapped right now?
Well, that stability is a bit misleading, I think. It's tracked because the market's holding its breath, waiting for the real data point, which in the U.S. is that PCE release.
Ah, the personal consumption expenditures number. The Fed's favorite inflation gauge.
Exactly. That's why it's so tight. Traders want to see if that data actually confirms this whole slowing inflation story everyone's talking about.
And the policymaker commentary, it certainly pushes that easing narrative hard. Look at Europe, USD around 1.1728. ECB's Šimkus was pretty explicit, wasn't he? Said a December cut is needed to get inflation safely back to 2%.
Yeah, needed. That's not just a hint, is it? That's basically laying out the plan. It's a really strong signal of their intention over there in the Eurozone.
And the framing is interesting, too. Needed to achieve the target. Suggests they are now more worried about inflation going too low.
Precisely. Risk of undershooting is now top of mind, it seems. And we see something kind of similar with the Bank of England. Sterling's holding above 1.3450.
Everyone watching Pill and Bailey there.
Yeah, definitely. And especially with the UK flash PMIs coming out tomorrow, that'll be a key check on economic activity.
Okay, meanwhile, back in the U.S., the Fed comments have been, well, unusually blunt. Governor Mullen saying disinflationary forces are in play. And then just stating it, we are in an easing cycle.
It's pretty hard to read that any other way, isn't it? Just direct confirmation.
Yeah.
And then you had Fed's Daily backing that up, pointing out the job market has softened quite a bit over the last year.
So connect the dots. The dollar's flat, but policymakers are actively shouting easing ahead.
Exactly. They're trying to lead the market, but the market's saying, show me the data first, waiting for that hard evidence on just how fast things are cooling.
Okay, let's shift over to Asia. Japan, USD JPY pushing up towards 148. What's the story there? It's less BoJ now, more politics.
Yeah, exactly. Attention shifted from the Bank of Japan to the LDP leadership race. And the candidate seen as more dovish, Takaichi, she polled quite strongly, 28.3%.
And dovish policy expectations usually mean a weaker currency. Makes sense.
Yep. And then China gave us a really fascinating glimpse into their own economic pressures.
How so?
Well, the PBoC set the dollar-yuan midpoint a bit firmer than expected, 7.1106. And they kept their main policy rates, the loan prime rates, unchanged. 1 year at 3%, 5 year at 3.5%.
Standard stability message there.
Right. But the real action was kind of hidden in the plumbing, the liquidity operations.
You mean the big injection?
Massive injections. They put in CNY $240.5 billion through the usual 7-day reverse repos. But then, crucially, they also pumped in CNY $300 billion using 14-day reverse repos.
And that's significant because
they haven't used that 14-day tool for 8 months.
Yeah.
Think of it like pulling out a bigger fire hose. Bringing that back after such a long break suggests there are some real persistent liquidity strains under the surface.
Yeah.
Strains they're trying to tackle aggressively, even while keeping the official policy rates looking steady. It's about supporting internal stability, almost separate from what the rest of the world's doing with rates.
Right, supporting things internally. That's a key takeaway. Okay, let's pivot now. Section 2, commodities. Because this is where that easing story you mentioned just crashes headlong into the risk story. Crude futures popped pretty quickly on security news.
Oh yeah, the link there is direct, immediate. Crude firmed up because of those tensions in the Baltic Sea.
The Estonia incident.
Right. Estonia triggered NATO Article 4. That was after 3 Russian MiG-31 jets flew into their airspace near Vainloo Island, and Germany scrambled jets too.
And for you listening, Article 4, that's the formal request for consultations among NATO allies when one member feels threatened. It's not Article 5. The attack on one is an attack on all part.
Correct. But triggering Article 4 is still a big deal. It formalizes the crisis. It signals this could be a longer-term shift in NATO's posture, which basically raises the baseline level of geopolitical risk permanently.
And the market prices that duration risk in.
Exactly. Plus, you've got supply pressure building. The U.S. president commented that Europe won't be allowed to buy Russian oil much longer. That threatens to tighten supply even more.
Even as Iraq is actually increasing exports now that their OPEC plus cuts are ending.
Yeah, so the market's trying to weigh these things up. Geopolitical supply restrictions versus potential OPEC plus supply increases. Which one wins out? It's messy.
And the sanctions just keep coming, don't they?
Yeah.
The EU's 19th package on Russia looks pretty hefty.
It's huge, really comprehensive. They're banning imports of Russian LNG, that's liquefied natural gas, a big deal for Europe, but maybe even bigger for global trade.
The ships.
The ships. They sanctioned another 118 vessels. That brings the total number of sort of shadow fleet vessels under sanction to over 560.
Wow.
That doesn't just hurt Russia. It tightens the market for all shipping, raises insurance costs everywhere as the pool of safe ships shrinks.
Right. And then full transaction bans on Rosneft and Gazprom Neft too.
Yep. Plus reports of Ukrainian drones hitting oil pumping stations linked to exports through Novorossiysk. So you've got this multi-pronged pressure hitting Russian export capacity hard.
Which just makes doing business globally more expensive, feeding inflation, even while central banks are trying to signal easing. What a conflict.
Exactly.
Okay, shifting within commodities metals. Gold showing that safe haven appeal, right? Holding just under $3,700 an ounce.
Yeah, classic flight to quality. It perfectly reflects that global instability we're talking about. Copper, though. Different story.
Faded a bit.
Yeah, copper futures slipped. Even though there were reports of a productive call between the U.S. and Chinese leaders, the weakness in Chinese markets seemed to pull copper down. Suggests industrial demand worries are still outweighing any diplomatic optimism for now.
And we had some supply-side news there, too, constraining things.
We did. 2 key things.
Yeah.
First, Chile's Codelco, big copper producer, said its largest mine will take longer than expected to get back to full production after that bad tunnel collapse back in July.
Less copper supply.
Right. And second, China pledged tighter controls on its steel sector, specifically banning any new production capacity.
Why are they doing that?
It's mostly an internal thing, trying to manage pollution, deal with oversupply, but the effect is global. It limits potential industrial upsides. So you've got constrained supply meeting, maybe muted demand signals, keeping industrial metals like copper sort of range-bound.
Okay, let's go deeper on the security side in Section 3. These hotspots are really driving that risk premium in commodities. The Baltic crisis, the implications seem to be spreading fast.
Yeah, the immediate thing is that North Atlantic Council meeting early this week because of the Article 4 trigger. But it's escalating beyond just NATO.
How so?
The UN Security Council is also meeting at Estonia's request, and European leaders are set to talk about a collective response on October 1st.
So NATO, the UN, the EU, all 3 major bodies getting formally involved very quickly.
Exactly. That tells you this isn't being seen as just a minor airspace violation. It's viewed as a major turning point for regional security.
Okay, let's shift to the Middle East. We saw a very quick, very sharp reaction to several countries recognizing Palestinian statehood, the UK, Canada, Portugal, Australia.
Immediate reaction. An Israeli official came out saying full or partial annexation of the West Bank is now being considered in response.
That creates a really dangerous feedback loop, doesn't it? Diplomatic moves met with annexation threats.
Which ramps up instability, which then prompts military reassurance from allies. Case in point, the U.S. is apparently planning a huge new arms sale to Israel. $6 billion worth.
What's in that package?
Things like 30 Apache attack helicopters, over 3,000 infantry assault vehicles. It's significant hardware. It really underlines the heightened tension and provides very concrete military backing amid all the rhetoric.
And the cross-border stuff continues, too. Israel reported killing a Hezbollah member in Lebanon, acknowledged civilian casualties as well. It really feels like a powder keg.
It does. And meanwhile, you look over at North Asia, the security picture there seems to be solidifying into clearer blocks.
You mean Russia and North Korea?
Yeah. South Korea's president specifically warned that cooperation between Russia and North Korea is becoming a really significant threat to the region. That axis looks more and more formalized.
And North Korea itself isn't budging on talks with the U.S. Kim Jong-un ruled out talks unless Washington drops the whole denuclearization demand completely.
Right, which under the current terms basically makes high-level diplomacy impossible. Stalemate.
Okay, one diplomatic date to maybe keep an eye on, though, that connects security and trade. Turkey's president visiting the U.S. on September 25th.
Yeah, that's interesting. Talks are expected to cover trade deals, but also major defense deals, specifically F-16s, maybe even F-35s down the line.
And those big defense sales are always about more than just planes, aren't they? They're leverage points in geopolitical alignments.
Absolutely. Which leads us perfectly into Section 4. Trade, policy friction, and those looming deadlines. Because we're seeing how security is being used explicitly as trade leverage.
Right. Despite all the friction, there are some attempts at stabilization. A U.S. House delegation actually visited China. That's the first since 2019. Just the visit itself is a signal, isn't it?
It is an effort to reopen high-level communication channels. And the messaging around it was somewhat conciliatory, too.
Like the president's comment on TikTok.
Exactly, promising we will not allow anything bad to happen to the TikTok app. That's a very specific signal to Beijing, suggesting maybe a desire to de-escalate on certain trade flashpoints.
And China, for their part, called for a fair business environment in the U.S., standard stuff.
Yeah. But here's maybe the most striking piece of insight on this whole balancing act, the strategic use of military aid.
What do you mean?
Reporting suggests the U.S. actually held back approval for over $400 million in military aid to Taiwan this past summer.
Withheld aid to Taiwan. Why?
Apparently because they were actively pushing for a trade deal with Beijing and trying to set up a potential summit between the leaders.
Wow. So Taiwan's security essentially used as a bargaining chip for U.S.-China trade talks.
That seems to be the implication.
Yeah.
It really highlights the current administration's priorities, perhaps, shows a willingness to link security commitments directly to achieving diplomatic and trade goals with China.
That's something with huge implications for allies everywhere, surely.
Definitely. And at the same time, you've got these big domestic policy changes creating new friction points, new barriers, like the H-1B visa fee.
The new one, $100,000.
$100,000 per year per firm. That is a massive barrier. It's not just a fee, it's a strong policy push towards domestic hiring. It's going to severely squeeze sectors that rely on specialized foreign talent, AI, advanced engineering, tech.
It feels like protectionism dressed up as a fee.
Pretty much. And hanging over all of this policy maneuvering is that ticking clock in Washington, the September 30th deadline to avoid a U.S. government shutdown.
Yeah, that's coming up fast. Senate's back on the 29th, but the House not until October 7th. That timeline is tight.
Really tight. It massively increases the risk of just policy gridlock, maybe even a shutdown. And that domestic chaos inevitably sucks up bandwidth, making it harder to manage any of these external crises we've been talking about.
Right. Less capacity to deal with the Baltic, the Middle East, China, anything.
Exactly. And you see similar clampdowns elsewhere, too, like the EU reportedly looking to block big tech from a new financial data sharing system. The policy reins are tightening everywhere.
Okay, so let's wrap this deep dive up. Let's synthesize that core conflict we started with. The key narratives seem interlocked, don't they?
Yeah.
Monetary policy is signaling ease, big Fed, ECB doves. But global security risks are actively spiking the Baltic, Middle East tensions, driving up that risk premium.
And policy leverage, like the Taiwan aid situation, those H-1B fees, is being used strategically, transactionally almost, to try and manage these pressures.
So for you listening, what are the highest priority risk signals to watch this week?
I'd say two things really stand out. First, those formal NATO consultations on the Baltic airspace incident. That's a live escalation risk that feeds directly into energy prices. Keep a close eye there.
Okay. And second?
Second, honestly, is that ticking U.S. budget clock. That September 30th shutdown deadline. It sounds like a domestic issue, right? But it puts immense pressure on the entire U.S. policy apparatus and by extension, global economic stability.
It really does. So let's leave you with a final thought connecting those internal pressures to the external levers. How might the looming threat of a U.S. government shutdown actually influence the administration's flexibility on some of these external trade issues in the immediate short term?
Yeah, things like those H-1B fees, or maybe even revisiting those military aid approvals we talked about. Does the domestic pressure make them more or less likely to concede something internationally?
What stands out to you as the single most unstable factor in this whole complex global picture right now? Lots to think about. We look forward to diving deeper with you again next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.